I mentioned this briefly before, but we often get asked questions from investors. How does direct lenders compete with banks, for smaller borrowing financings? Why aren't banks the natural lender to these middle market borrowers? Because can't banks offer cheaper pricing, which would make it more appealing to a smaller credit? Now, while banks definitely were the first ones in the market lending to smaller borrowers many, many years ago, we've seen a shift away from the regulated banks to investors and direct lenders following the Great Financial Crisis because of Dodd-Frank, because of leveraged lending guidance, and all the onerous regulations that have been put on the banks. They have to set aside so much capital to do these middle market loans that it makes them less lucrative. And so the types of deals that we see now is mostly going to the direct lenders, and the types of deals that banks do and direct lenders do are vastly different. So direct lenders are mostly focused on earning returns on the asset by itself, while banks are rationalizing their lending to borrowers who offer them heavy fee income and ancillary business, which not a lot of middle market borrowers have. So 80 to 85% of direct lender deals are for M&A related reasons, for fast-growing companies that private equity shops are looking to finance, while banks are more focused on non-sponsored borrowers and providing them working capital and relationship loans. So very different markets. You will find that direct lending deals are funded term loans with very small revolvers, and they're priced much higher, whereas bank financings are heavy ABL, revolvers, pricing's much lower in the 200 to 400 basis point area. So very, very different markets. Moving to slide 9. This visually shows you the trend that we're just talking about, that we've been witnessing for nearly 2 decades, of middle market loans leaving the banking system and being financed by the non-bank lender universe, which also includes not just direct lenders, but it could be CLOs, asset managers, insurance companies. Moving to slide 10. Now, we know that regional and commercial banks want to minimize the amount of middle market loans on their books, particularly PE-backed deals, but many of the bigger investment banks are still quite interested in underwriting larger transactions with the intent of selling them to institutional investors so they can make lucrative underwriting fees. And they do this while holding no risk, right? Because mega deals, big billion-dollar deals are higher in fees. So that model started to become quite popular the few years before the GFC, during what we used to call the buyout boom, with the birth of CLO and the shadow banking market. But over the last 5 years, something we've seen in the direct lending market is we started to see direct lenders leading some of these bigger deals now, which is a huge opportunity. Sponsors are coming to truly appreciate working with these direct lenders, building deep relationships with them. And this is allowing these sponsors to bypass the banks altogether. And so syndicated executions are even now becoming less relevant, with direct lending taking meaningful market share. And so as direct lenders have raised more money and they're growing their scale and their size over the past 10 years, they've also been able to increase their hold size, which is allowing them to compete with the banks for these large corporate borrowers with deal size as much as $5 billion. So we're not just doing middle market deals now, we're starting to move into the large corporate space. Deals of that size used to only be able to access financing in the syndicated and high yield bond market. So this has been a huge positive to borrowers. Now, this slide highlights to you why a private equity shop would choose a direct lending execution over a syndicated execution today on either a middle market loan or a large corporate borrower. Really, the key differentiator is direct lenders eliminate execution risk. Once a direct lender commits to a deal, they hold that piece of paper they committed to, and the sponsor will club that deal up with several direct lenders. Each direct lender is committed to their individual hold that they're comfortable with, and there's no risk of not being able to sell it down. So this provides sponsors with certainty of close. Direct lending capital is also more sticky and long-term in nature, right? These lenders go out, they raise private funds, separately managed accounts. Much of these vehicles have 5 to 7 year lives. This money's locked up. If they go out and raise BDCs, these can be permanent capital. They stay out there forever if a lender were to take one of them public. This all makes these lenders more reliable financing sources relative to what you can get to the syndicated market or the high yield bond market, which has hot money coming in and out and can quickly dry up during periods of market dislocations. Direct lending executions also shorten the time frame for a deal to close. They eliminate the need to go get a rating, You don't have to hire a bank to underwrite a deal, and they charge you 200 to 400 basis points to underwrite that deal. And you don't have to worry about the market today where, deals are getting sold at deep discounts because there's not enough buyers or there's a huge dislocation. So sponsors and borrowers like that. Now, on the flip side, why do people go to the syndicated market? Well, it's a deep market. It has a lot of depth, scale. If you want to maximize your terms, get the cheapest pricing, that tends to be a more attractive market because direct lenders are more expensive. Moving to slide 11. This highlights the long-term market opportunity for direct lenders to finance deals. Because if direct lenders are raising all these funds, as you can see in the blue bar, you want to ensure they have enough deal flow opportunities to invest, right? LP money as it comes in and deliver on the returns they promise. As you can see by this chart with the green bars, which is private equity dry powder, these shops raise 5 times the amount of capital that direct lenders do. While a typical M&A deal is comprised of 50% debt, 50% equity. So this implies that direct lenders have plenty of deals to choose from if sponsor finance is their focus. And as you can see by this data from Preqin, as of 2021, PE shops have over $1 trillion of dry powder. So this implies there's a long runway for direct lenders to invest and maintain relevance for the foreseeable future. Moving to slide 12. This chart compares the amount of borrowers or the count of borrowers in the direct lending universe versus what's in the broader institutional market. So I used Fitch's Leveraged Loan Index, which is shown in the light blue line. This is a $1.7 trillion index in terms of outstandings. But as you can see by the count, it only comprises about 2,000 borrowers, which is up from about 1,200 borrowers 6 years ago. Meanwhile, if we look at the amount of unique borrowers in our index, the Cliffwater Direct Lending Index, which is the dark blue line, there are 9,000 unique borrowers versus 3,000 6 years ago. So it's tripled in a very short time frame. This highlights the trend that smaller borrow opportunities are vast in the US and growing at a much faster rate versus what's in the institutional loan market.